rental apartment market for BOMA Manitoba's inaugural session on the topic. It's certainly an exciting time in Winnipeg for the rental apartment market. The city is experiencing a bit of a renaissance in development. The optimism that was growing just prior to the pandemic shows no signs of slowing, and increasing numbers of investors and developers from across the country are turning their attention to our fair city. Historically low interest rates have allowed for increased capital in both the debt and equity markets, and multi-residential rental properties remain a very attractive investment. They're relatively resilient. Consequently, while certain other sectors of the industry, such as hospitality, entertainment, and some retail, have been severely impacted by the pandemic, the apartment rental sector remains relatively unscathed. This morning's panel will walk us through Winnipeg's apartment market, starting with a macroeconomic market overview at both a national and a local level, a brief look at local apartment supply and pending supply, an overview of important factors relevant to the valuation of these assets, and finally, an overview of property tax considerations for apartments, including assessment methodology, as well as some guidance for best practices with regard to this expense. Our speakers this morning are Peter Norman, Vice President and Chief Economist for Altus Group, who is joining us from Toronto to provide the market overview. Sandra Kulchyski, Managing Director for Altus's Winnipeg Research and Valuation team, will discuss the valuation aspects of this class. And Kerry Reimer, Senior Director with the local property tax team, will discuss property tax issues for this asset class. So with that, I'd like to pass it over to Peter. Good morning, Peter.
Good morning, Rod, and good morning, everybody. Thank you very much for having me at this presentation and the opportunity to speak to you. As Rod said, I am from Toronto. I am sitting in Toronto right now, but my heart is always in Winnipeg. So here is going to be here is going to be a good opportunity for me to show that. So that's great. It's probably a little bit warmer here as well, so that's also nice. Thanks very much for having me. I am going to speak a little bit about just to set off the tone of this webinar. I'm going to speak a little bit about the economy to begin with, and then some factors going on in the rental market right now in Winnipeg. This is going to be an opportunity to kind of contextualize what's happening right now with respect to obviously the influence of the pandemic, but also to speak a little bit about longer term effects and how quickly some of those pandemic effects will turn around as well. What I like to do usually is start pretty high with this type of thing and speak about the economic growth from a larger kind of macro perspective to begin with. And the pandemic clearly is having an influence on potential economic growth and potential population growth in places like Winnipeg and elsewhere across the country. And the view that's in front of you right now might seem kind of familiar in many respects. I'm not going to analyze it too much, but of the economy in Canada, in the United States, around the world, shrunk significantly in 2020. In Canada, we had about 5.5% decline in the overall size of the economy. That was actually somewhat more severe than in the United States. A lot of people think that Canada came through, or at least feel or want to feel that Canada came through the pandemic, or at least is coping with the pandemic in a better way than the US. Certainly we had better results on the health crisis side early on, but our economy took a much bigger hit as we went through that. And our recovery from the pandemic, as you can sort of see the forecast components there everywhere, whether you're looking internationally, you're looking at the United States and Canada and Manitoba, everywhere will have very strong economic growth this year, really kicking in later in the year once that kind of herd immunity shows up, et cetera. But still, that recovery in Canada will be not quite as robust as in the US, but will probably be a bit longer lasting. The US will have a little bit, will normalize more quickly. And the Manitoba situation as well will have, perhaps as much as about 4.6% growth this year, which is an extraordinarily strong year of growth, if that's the case, and particularly with it all coming in perhaps in the second half of the year, That's even going to more underscore it. But nonetheless, it's on the backs of a very steep recession this year, and we need to take that into account when we talk about the economic impact of the recession due to the pandemic going forward. We have to remember that it's not just putting everything on pause, and then as soon as everybody gets their jab into their arm, everybody's going to get back to normal. It's also a fairly steep recession, and a lot of impacts have taken place as a result of that. Just sticking with GDP for a moment here, and zeroing in on the Canadian situation. The size, we often talk about GDP just in terms of percentage growth, et cetera. But it's important to remember that the size of the economy shrunk in 2020 by about $50 billion. That's the loss of capacity. It's a loss of income, although there were government income supports. There's no free lunch in the end. It's income loss through the system, and those losses in the end, no matter how quickly we kind of get back to solving the health crisis and get back to our normal routines, those impacts will continue to linger with us for a few years to come. And I guess one way to think about that, and you sort of look out to the end of my forecast that I'm showing there, out to the end of 2022, that even at the end of that point in time, after 2 fairly strong years of growth, we still remain billions of dollars smaller than the economy would have been if we had not encountered this crisis. So that's a way of understanding how those lingering impacts will continue to be with us. And then over onto the right-hand side, quickly, is just the distribution of effects, and it clearly has not been evenly spread across the economy. In fact, it's easy to know that areas like arts and entertainment and accommodation, which is the hotel sector, and also the restaurant sector, et cetera, have had severe negative impacts. Transportation as well, because of air travel. But most other sectors also have had continue to have modest declines in economic activity from pre-crisis levels. And really only residential construction is one where we've seen residential investment, I should say, one where we've seen a kind of a tick up, and some of the associated sectors with that, like finance and insurance. And so really across the board impacts from that recession. And then just finally, bringing that into the employment lens, when we look at, again, just across Canada, keep it nice and smooth at this point in time, lots of losses of jobs. We lost about 3 million jobs. We gained back about 2.5 million jobs during the fast growth during the summertime, but that leveled off in the fall and it's starting to come back down. That's the second wave of the health crisis. And the positive news that comes out of this, really, and one of the main reasons I'm showing this chart, is that it's illustrating that as we go into subsequent waves of the health crisis, and there may be another wave ahead, as an example, as we go into subsequent waves of these health crises, the economic impacts are milder. They're still negative, but they're milder as we go forward. The second wave has resulted in job losses, but not nearly as steep as the first wave, as you can see there. In terms of the overall scorecard on job growth, Canada as a whole is down almost 800,000 jobs right now. But as we go across the country, areas like BC and Atlantic Canada have fared a lot better. I mean, they're not above zero in terms of the net number of jobs, but they've fared the best across the country. And then Central Canada, Ontario, and Quebec about average, and then Manitoba, Saskatchewan, and Alberta are the ones that continue to be furthest behind in terms of the level of employment that existed prior to the crisis. Drilling into Winnipeg a little bit, on the left-hand side, we just get a sense of the waves of the health crisis and how that's had an impact. And as you can see, the impact from the second wave in terms of job losses has been about half as strong as in the first wave, but nonetheless, it is important. And when you look at those cumulative impacts, the Winnipeg economy right now, as we talk, is sitting at about 22,000 jobs weaker than it was prior to the crisis. And that's significant. That's significant, even though, again, it's government supports government program supports of various types that are kind of masking some of the negative aspects of the crisis. We continue to have a much slower economy, and we need to bear that in mind when we're answering the question about how fast things will come back, how fast the demographic will come back, how fast consumer spending and people making normal housing choices will come back after this crisis. And then over on the right-hand side, I just want to stress one point. I mean, you see that same pattern. There were about 15,000 job losses last year. Recovery this year, we expect to be quite strong, about 10, in excess of 10,000 jobs this year, another pretty close to 10,000 jobs next year. But one thing that's important to remember is that the Winnipeg economy, the way that it grows, what has kind of defined its path right now, what has set us up for the types of housing choices and consumer behavior that we were used to in the last couple of years, grows at about 5,000 net new jobs per year. That's a kind of a typical rate. And taken together, 2020, where there's losses, and 2021 and 22, where these gains, over those 3 years, we're still just talking about 1,800 jobs, so below 2,000 jobs as an annual average growth. And so we will go through a kind of a prolonged period of somewhat slower growth, and I think that's important to remember. I'm not going to analyze the unemployment rate, but people like to see them. I mean, they shot up during the first wave, they recovered a lot, and now they're kind of moving up again. At the Canada level, current unemployment rates are about where they were at the peak of the 2009 recession. Manitoba didn't really participate too much in the recession in 2009, which was good, but and that makes current Manitoba unemployment rates at a kind of a fairly elevated rate by a historical standard. But there is good news. I'm showing national data here, although it's very similar in Manitoba. It's just that the national data is a bit smoother to show that, on a number of household household balance sheet metrics, which of course are important for housing choices, things are looking pretty good. Debt to income ratio has been falling during this crisis. The debt service ratio, because of those super low interest rates that have come in, have come down, and the savings rate, of course, has really shot up as people, at least in the early points of this crisis, have had very little to spend their money on and tend to be saving it. And there's still a lot of people are receiving government supports, et cetera, as well, and a lot of that is being saved. And so the savings rate has elevated. I'm going to be orienting my comments towards the multifamily sector in a few minutes, and of course there's kind of positives and negatives from this when we're talking about the health of the potential renter base as we go forward. Certainly you want good economic growth in order to fuel the demand side for rental apartments, because people need to have jobs in order to form households. Vibrant economic growth brings in migration, which of course fuels a lot of demand for rental apartments. And in addition to that, people need to be able to have healthy balance sheets and economic lives in order to basically to pay the rent and to continue to show some demand for rental apartments. But on the flip side, once things like debt to income and debt service ratios go down too far, you also fuel a lot of ownership demand, which can have some negative impacts on the multifamily sector and the multifamily rental sector. And I just want to switch gears now and look a little bit at migration, because I just spoke about the vibrancy of the economy and how that flows through into demand, but obviously a big, very real component of demand, particularly for rental apartments, is population growth, and in particular population growth that's fueled by in-migration. New migrants, whether they be international or coming in from other provinces, often fuel demand for rental apartments early on, even if there's a switch to ownership later on in somebody's time in Winnipeg. And during the crisis, clearly a decline in international migration was one of the big impacts, and that's continuing straight through to today, and likely won't start to see more of a recovery until at least next year. And so at the national level, what that means is that we had population growth for the last few years in excess of the 500,000 person range. And that was largely fueled, about 80% fueled by net international movements of persons. And that has really, those international movements have declined significantly or moderated significantly. And overall population growth through to September of last year, the 12 months leading to September of last year, was only 200,000 persons. So less than half of what we have seen in the last number of years. And it's still a majority of that growth is international migrants as opposed to natural, which has been getting a little bit more moderate each and every year. But nonetheless, that decline in migration has been pretty critical in terms of creating risks for segments of the market like rental housing and housing in general, even though the ownership market has been fueled by some of those other factors like lower interest rates. At the Manitoba level, there's been a negative shift in overall in migration, international immigration. Those numbers actually are picking up people moving to other provinces. And population growth remains positive in Manitoba because there's still a lot of natural growth, but there was a negative influence from it. Now, the Winnipeg numbers are a slightly different time period because that's the 12 months ending in July as opposed to September. So it's not picking up all of those pandemic effects quite yet. So just take those with a grain of salt, but it does certainly show the same trend as in terms of really coming off that recent pattern of somewhere between about 12 and 16,000 net new people per year, down to about 6,000 net new people in the 12 months leading up to July of last year. And without a doubt, the 12 months leading up to July of this year, when those data come out, will show a much slower rate of population growth in Winnipeg, because that will then kind of include 4 quarters of pandemic as opposed to just one. And the population of Winnipeg, by the way, in July, middle of last year, was 850,000. And switching a little bit into new construction and the trends there, just at the Canada level, a very strong year actually for new construction, 218,000 net new, housing starts, I guess, net housing starts. And that was up from the last few years, one of the strongest years we've seen in quite a while. That's a big surprise, to be frank, given pandemic conditions. We started doing some forecasting very emergency forecasting very early on in mid-March when this crisis was hitting. And we were really thinking we might be looking at something like about 150,000, 160,000 for the year. And it certainly well exceeded that. The home sales came back really, really strong in the summer in almost all markets across the country. And that showed up in terms of housing starts. And in Manitoba as well, you can see right in the middle of the pack there, positive. Those are absolute numbers, so it obviously looks a bit smaller than central Canada, but still a fairly strong rate of growth of new housing construction. So a very similar picture. Drilling a little bit into Winnipeg, I guess over on the right-hand side, I would expect to see, we had about 5,000 housing starts last year. I would expect to see that moderate a little bit this year. I'm going to get into some oversupply issues in a minute. Those economic factors I was talking about, and also the slower population growth will certainly come through in terms of the housing start profile into 2021. I've got a little bit of a recovery into 2022, and we'll see how that plays out. But I think that's a likely kind of outcome that we'll start to see that kind of a little bit of pent up demand coming through later in 2022. But nonetheless, bit lower profile this year. And then just drilling into multifamily now a little bit. I just wanted, and this is a comparative chart. I think this may be kind of useful. So last year there was about 27. The last chart, it said there was about 2,700 apartments started in Winnipeg, and that breaks out being mostly purpose-built rental housing, and which is the asset class we're here to talk about today. In fact, Winnipeg, there are only about 290 units of registered condominium apartment starts last year, and that puts Winnipeg at about 90 last year, at least at about 90% purpose built versus condo, and that's quite a high number in comparison. It's really the highest of all of these centers that I'm showing you right now in terms of the mix of purpose-built versus condo. And you can see that it hasn't always been 90 in Winnipeg, but it's always been kind of in excess of the trends elsewhere. It's definitely a market for multifamily, more so than for the condo sector where it comes to demand for apartments. As probably most know, the condominium apartment market in most places across the country really primarily services as another form of rental supply. Rental supply comes from two forms, well, principally from two forms. One is the purpose-built apartment buildings, the type of asset class we're talking about right now. And then the other are individual investor-owned condominiums. It's that a much lower factor in the market is owner-occupied condominiums. That doesn't tend to be a very strong factor overall. Mostly the condominiums go into the rental supply, and in recent years. But in Winnipeg, it's the market is clearly showing a lot better, a lot stronger demand for kind of purpose-built rather than through the investor channel of investor condo channel. And then just drilling a little bit more into the purpose-built number. I mean, the last one showed the trend of it increasing. This shows it perhaps a little bit more starkly, that at almost 2,400 units started last year. That's our strongest year in over a decade, and in fact longer if we had illustrated this for purpose-built apartments. So the supply is definitely ramping up in the last 3 years. I think that it's a good move right now for BOMA to be spending this time trying to get a hold of this asset a little bit more and to understand, to provide services to it, because it is becoming so much more important right now as we go forward. And then another little bit of a view to put things into context. This is the universe of purpose-built, at least according to CMHC. Altus Group and Rod will speak a little bit. Altus Group has our own database of universe that differs a little bit from this number, and he will speak to that. But at least from the CMHC perspective, there are about a little over 62,000 units in Winnipeg. That's up a little bit from last year, or up a little bit from 10 years ago, just because of the recent contributions, obviously, from new units. And there's kind of two kinds of markets across the country, actually. There's Quebec and the East Coast, which are very dominated by rental apartment stock. As you can see there, the stocks are somewhere around 12 to 13 units per 100 people in the population, and that's a real step up from most of the rest of the country, where we sit at about 5 units per 100 people in the population. And Winnipeg's a bit on the high side of that norm for the rest of Canada. I guess that's one way to say it. About almost 7.5 units per 100 people in Winnipeg, a purpose-built. And it really does, underscore a couple of the comments I've made so far, that this is an important asset class in Winnipeg, and has been traditionally as well. Vacancy rates have been ticked up last year, but not by much. I mean, in Winnipeg's case, we saw vacancy rates tick up to about 3.1%, well within the kind of norm of a balanced market. In fact, it's not even a record high. In some other markets, we are seeing vacancy going to upper high, as you can see on the right-hand side of the panel there. If you look at places like Calgary and Edmonton, much more severely impacted by the COVID effects, I would say, and migration effects than what we have seen in Winnipeg. So any kind of tick up that we have seen, I would say, has more to do. Any kind of tick up we see in Winnipeg probably right now has more to do with that new supply which is coming on. So when we look at the new supply here illustrated, this is now completions rather than starts, which was the last thing we looked at, but more or less the same concept. We completed about 2,300 units last year in Winnipeg, well up from what we've seen before. And those new units hitting the market certainly contributed to that very modest uptick in vacancy rate. So it's not, right now, it's not at least to date. And these vacancy rates, of course, measure October, so it's sort of very late in the year last year. At least to date, we're not seeing a significant demand reduction in Winnipeg as we are in some other markets. Toronto and Vancouver have both seen a big reduced demand for rental apartments, albeit somewhat temporary. Both of those markets, and Montreal as well, have very strong student housing components to the rental markets, much more so than Winnipeg. And that's one of the components that have led to the higher vacancy rates, because a lot of students just simply aren't in the apartment market this year for obvious reasons. And then finally, this is the final set of my comments on this slide, just looking a little bit at rent, looking at a little bit at the revenue, looking a little bit on the rent profile by bedroom. I've got some illustrations there. We've had about a little over 4% average annual growth over the last 5 years. Those lines show a little bit more than the 5 years, but you can see, even over the last decade, we've seen a real kind of a little more than a decade, a pretty steady growth in rents, depending on what it is. Rents obviously are a little bit higher on the 3-bedroom than the bachelor, and the growth has been a bit higher on the 3-bedroom as well overall. But nonetheless, we're all in that kind of a category of somewhere between about 3 and 5%. Growth on an average annual basis. And just a comment or two, and I think this will come more to play as we go through the comments from my appraiser and tax colleagues coming up. But the rent numbers, the rent and revenue differs substantially by the age of the structure. So newer structures, ones that have been built in the last 15 years, are receiving about a 23% rent premium, and I think that that's an important factor to bear in mind as we think about those the rent profiles, both in terms of the level of the rent and also in terms of the the growth and where the growth might be coming from. So with that, I'm going to turn it over back over to Rod, and again, I appreciate everybody inviting us down to talk to you, and I look forward to the question period to talk to you a little bit more. Thank you, everybody, and over to you, Rod.
That's great. Thank you so much, Peter. That was an excellent overview of both the national and the local economy and how it affects the rental market here. I had a couple quick questions before I talk about supply. You had mentioned that the population growth in Winnipeg is moderated. It was over 12,000 people in 2019, and the growth is down to just under 6,000 in 2020. Do you anticipate that with vaccinations and as we get the pandemic relatively under control, that we'll see a bounce back to those pre-COVID levels of population growth?
Yeah, I anticipate a bounce back to pre-COVID levels of migration. Let's just leave it at that, because there are other longer term factors going on with natural growth, but anyway, of migration. But it's difficult at this point in time, Rod, to peg the timing on that. So I'm certainly working on the 2022 idea that's when, we'll both at the national level and locally, we'll see a more of a return to normal in terms of those international flows. But that's not certain, right? I mean, we don't know how many more waves of this there's going to be. We've got vaccinations. We don't know how we don't know how they're going to last. We don't know how they're going to deal with new variants and things like that. So there continues to be an elevated risk profile. And as we've seen before, the international flows continue to be something that really requires full normalization before they go back. So whether that's 2022 or 2023, it's hard to say. We do know that the federal government has already provided signals that once things open up, they will be opening up immigration more strongly in order to try to potentially make up for some of the lost ground. So we'll see how that plays out. I think in the more medium to longer term context, I mean, Canada continues to be a very attractive destination for immigrants, and I see no reason why that would be any different in the years ahead than it has been in the years behind us.
Mm-hmm. You know what, your answer actually underscores something that I gather from a lot of what you're saying is that, I started off the presentation talking about the excitement, and what you're talking about is that despite what people say about COVID perhaps being an event, that there are lingering effects of this, and mainly there is a lot of uncertainty. And right. I think that's very clear in what you're stating. The last question, Peter, is you mentioned the rent increases in Winnipeg, and they're very healthy. I mean, over the period from 2006 to current, we're seeing, as you mentioned, an average increase per annum of over 4%, very healthy. How does that compare to other markets?
Yeah, so it's really a mixed bag as you go across the country. In general, multifamily has been doing pretty well, but if you look like over the last 5 years in Calgary and Edmonton, those markets that have really kind of hit the skids in the last couple of years, both of those are more like around zero, 0% growth. I mean, it hasn't been a lot of rent growth across the whole stock. But Vancouver is sitting at about 6% at the other end of it. That's a very healthy market, at least on the revenue side, on the rent side. Toronto has about 5, so that's similar to what Winnipeg's experience is, and Montreal around 4. So it's a little bit of a mixed bag depending on local conditions.
Right. Yeah, that's great, Peter. Thanks very much. And it's very interesting to see that sort of escalation in a market with rent controls. So I found that an interesting statistic. So with that, Peter talked a lot about the overall demand factors and going into the supply. And I'd like to talk a little bit. I don't want to take too much time, but Altus here in Winnipeg has been undergoing a full analysis of the apartment inventory in our city, trying to really get a handle on what is out there, what are the ages of these products, what is really happening in our supply and where is it going. So we're watching very carefully the pending inventory as well. So Peter, if you don't mind going to the next slide there, what we've looked at is, to be clear, what we start with is how the properties are assessed, so that you may have an older apartment, there may be a conversion on it, it may no longer be rental, it may be condominium. So what we do is we start with the assessment category that is, defining it as a rental apartment, either true rental or rental with mixed commercial, like on the main floor. These are often the towers. And there's 1,895 properties that we've analyzed. And one of the most important things that you can see from this slide, and it's something that everybody on this webinar would be well aware of, but Winnipeg has an older apartment inventory. If you look at this, these bars, basically 80% of our properties were originally constructed before 1980. And you can see the drop off in the ages as we move through the 80s, 90s, and into the 2000s. So we have a older market. Some may say it's in need of being refreshed. Others may say it's under demolished. In any event, the age is a big factor in what we're seeing now in both rehabilitations and new supply. On the next slide, we broke down the city for the purposes of this quick analysis just into 4 quadrants and then the center. So the northwest, southwest, northeast, southeast, and the center, which is pretty tightly defined as the downtown, the rivers the rivers on the east and south side, Osborne Street on the west, and then up into the Exchange. So when we look at our inventory across these 5 areas, we can see that the center is really where the oldest properties are, and most of us would know that. I mean, we have a significant number of pre-1946 in the center. The other thing I find interesting on this is that the West has had a larger, they have an older stock, but they have seen less of the stock coming in the 2000s. If we move to the next slide, breakdown by by property type, we see that most of the stock in our city is what we consider low rise, less than 3-story. And that makes sense when we talk about the older stock, because this was a common type of construction pre-1980, certainly pre-1946. So it makes sense, but it is a significant amount. That's 80% of our stock is in that category. And you can see that when we talk about the 1895 properties that we're looking at, it includes not only the standard apartment blocks, whether they be towers or the walk-ups, but also there's townhouses mixed in this, assisted living, there's a student dorm, and there's some smaller, very small 4 units or less included. Thanks, Peter. We'll move to the next. So when we take a look at the total number of properties, we have to understand as well that there's a considerable amount of subsidized housing in the mix. So what we do next is we try and break it down by unit, and we take out the subsidized because they're not really affecting the true market. And what we're left with out of the 82,500 total units that we would have in our city's universe, we have just under 70,000 that are what we'll call market. And actually, when you break out the townhouses and the smaller properties that I mentioned, you'd be closer to the number that Peter quoted from CMHC of around 62,500 true rental apartments. Thank you, Peter. How that breaks out by region, it follows very closely what we saw on the by property analysis. So the Northwest has the most with over 20,000 units. It's a large area. Now, keep in mind, by the way that we broke down these areas, this includes the Osborne Village area. It includes, or sorry, not the Osborne Village area, the Spence area. So there's a lot of new construction happening just west of Osborne in the Spence neighborhood. And then it goes all the way through the west to Westwood and all the way north up to the new developments in the north part of the city. So that's the largest by probably geography and number of units, followed by the Southwest, which you'll see is really the popular area now as far as new construction. The east side of the city is about 10,000 units in the north and the south equally. And the center is just under 8,000 units. Thank you, Peter. And again, when we look at ages by suites, we find it mirrors what we saw in the by property, with most of the units being in that 1960 to 79. The difference is, and I think this is interesting, the difference is that only 70% of our units fall in that pre-1980 category, as opposed to 80% of the properties. And the reason is, as we get newer properties, we see higher densities. So when we break down these suites by the regions and by age, we see consistently that 1960s and 70s stock is the most popular in all the areas. I had mentioned earlier that I find it interesting. I didn't realize this until I really started doing this analysis, but the West was more popular for construction through the 1980s and 90s than the East, but then you saw that reverse, and you can see that between the blue and the green graphs in each of the two areas. The east side of the city seemed to be more popular after the turn of the millennium through to 2015. And then, of course, what you see on the far right of each of the quadrants is the new growth or the new supply, and that seems to be mainly in the Southwest, although there is a lot happening all across the city, but the Southwest certainly is the most popular. Again, this area includes Osborne Village, the Seasons area that we see developing heavily, the Bridgewater area, but also the center. The center is seeing a bit of a renaissance. It was really slow through the first part of this millennium, and now we're seeing a resurgence in development. By unit mix, basically half of the units in our city are one bedroom, just under half, and not far behind are the two bedrooms at about 43%. We have relatively few 3 bedrooms and up, under 3%. And it was interesting, I noted Peter's statistics that seemed to be the unit that was seeing the largest increase in rents over the last 10 years. And bachelors are 7.33%. What's very interesting as well is, again, keep in mind that I've segmented out subsidized housing for the purpose of these statistics. And if you look at subsidized housing, actually, there's an equivalent number of bachelor suites in that smaller segment than there is in the true market. So if you looked at all 82,000 suites, the percentage of bachelor suites actually increases a fair amount. This is coming from CMHC, so this isn't our own data, but it mirrors what Peter was telling us earlier. I think this is very interesting as well. You can see the upswing on the top graph, which is rental construction, that there is far more new supply coming on the market than there has been in recent memory. You can see it's just shooting up. But what I find interesting, and Peter alluded to this, and it's different than other markets across the country, is it's conversely related to the number of new condominiums. Now, if you go back through the 1990s and even early 2000s, it appears that the two were relatively in tandem. You know, as there's growth in both condos and rental. But then all of a sudden around 2011, the two became opposed, as you saw condominiums become more popular, for example, in 2013 and 2017. I'm not sure why. Peter might have some insight into what happened there. But conversely, new apartment starts declined. And of course, what we see right now since about 2017 is condos have gone straight down and apartments straight up. We're sitting at over 2,000 new units coming in 2019, just before the pandemic. Thank you, Peter. I'll skip this slide, actually, Peter. You talked at length about the population moderation, the population growth moderation. So I'll skip that. And I'll end with what we see coming. So in addition to watching analyzing very closely what is out there, we're watching very closely what's coming. And what we do here is watch from the stage of permits. So we keep in mind, and we also watch that there is a lot of activity going. You see it through city council decisions, you hear it through media releases, but we call that longer term pending. We start our clock at when the permit's taken, and then typically we're going to see it on the market within 1 to 2 years. Also, I should note that this includes just recently constructed and occupied properties because they haven't yet been assessed. So they don't actually fall in our current inventory. When we take those three categories together, brand new, pending in a year, and maybe pending into the second year in 2022, you can see the number. It's over 6,000 new units coming. If we looked at our total inventory of apartments, we mentioned it was about 62,500. This is a 10% increase in the near future. It's sizable. A few things to think about with this new inventory. It's not the same. The new construction is a different design. It's certainly a different quality. It's high in amenities. It may be smaller in floor print, but what is slightly lost on quantity is certainly made up and more in quality. So it really provides almost a different market. And we can see that in the rents that it's attaining. As Peter mentioned, the rents attained for the new construction are about 23% higher, partly because of a flight to quality, partly because they're not under the rent controls that many of the older stock are. Where are these new properties coming? We saw it with the new inventory up to 2019. The Southwest is the #1 area, over 2,000 new units coming in that area. The center, right behind at 1,309 new units coming on. And the rest of the city is very healthy as well. You see development in each of the quadrants, but those two are the most interesting. I'll end this just by one comment. I've been participating in many conferences. I just was as an audience member on the Real Capital Conference, and there's a lot of talk about two things. COVID's an event, not a trend. And I think Peter pointed out very clearly that not quite that easy. There are lingering effects to things. The second point is that there is a flight from the urban. There's a flight to the suburbs, maybe, but it's likely temporary. In fact, if you listen to any of the investors and developers across this country, they all suggest that this is a blip. There's a tendency in human nature over the last 500 years for urbanization. The pandemic in that respect is likely more of an event, and we will see a return to the excitement that we were seeing in the downtown very quickly once the pandemic is brought under control. So thank you very much. It's nice to go through some of those statistics, and I will now pass it over to Sandra Kulchyski, Managing Director of our appraisal group, to talk about some of the valuation aspects in this asset class.
Thanks very much, Rod. I appreciate that. To provide a bit more of an introduction, I am the Managing Director of the Research, Valuation, and Advisory Division for the Winnipeg office. I work with a great team of appraisers, candidate members, and admin staff, providing a variety of appraisal and consulting services for all asset types, including, of course, the multi-res market. Next slide, please, Peter. Thanks. Not quite that far. For the first part of my presentation, I'd like to focus on discussions surrounding the COVID-19 pandemic and how it has impacted the Winnipeg multi-res market. In 2020, Altus Group completed several surveys in order to understand and track the impact of the COVID pandemic on the real estate market. We refer to these as our key assumptions surveys, which to date involves 3 separate surveys completed in April, June, and November. The first 2 surveys were undertaken in the midst of the initial COVID uncertainty, and they focused on 4 major asset classes: office, retail, industrial, and multi-residential. When our third survey was undertaken, it was recognized that the industrial and the multi-res markets were the most resilient asset classes throughout 2020. So our third survey targeted just the retail and the office sectors. Okay, now next slide, please, Peter. Thank you. We had responses from over 130 participants from across Canada for our June survey, representing 6 provincial markets, as well as a national portfolio perspective. I'd like to share the multi-residential results of our second survey with you. Although the responses date back to data collection from April and May, it is still considered to be relevant for our current trends. Next slide, please. All right. One of the questions asked in our survey pertained to rental collection, inquiring about the actual rental collection for the month of April versus anticipated rental collection for the month of May. Our Manitoba participants, which are shown here in light blue, indicated strong collection rates for both April and May at over 90%, one of the top performers across Canada and on par with Ontario and Quebec markets. Our survey also inquired about the perception of any changes in market rents arising from the pandemic. Corresponding with the strong performance in collection, the majority of the participants reported no anticipated changes in market rates for both top quality and lower quality multi-res assets across Canada. In Manitoba, again here in light blue, the responses were varied. However, the large majority anticipated stable or even increasing rents going forward, suggesting a stronger sense of optimism in our local market in comparison to the rest of Canada. When asked about the perception of vacancy looking forward, the large majority did not anticipate much of an impact from the pandemic, with overall vacancy expected to remain below 5% across Canada. However, in Manitoba, there was some pessimism in this regard, with some respondents expecting to see vacancy rates increase for both top quality and lower quality assets. One local participant pointed to a combination of the pandemic as well as the increasing supply in our market as being the culprit. And this last slide from the Key Assumptions survey asked about the impact of COVID on anticipated yields. The large majority, both across Canada as well as locally, anticipated no change in yields. In Manitoba, there was some uncertainty as to what the impact would be, with over 20% of respondents indicating that it was too soon at the time of the survey to predict the impact. All right. So in addition to data collected through our surveys on the perceived impact of COVID, we've also been keeping an eye on the potential longer-term impacts of the pandemic. A few of these include the potential impact of lower migration levels, on rental demand, as Peter previously spoke to. Is this going to rebound, and what is the recovery timeframe? Will we see an impact of working from home on the multi-res market, and will this continue to be a trend beyond COVID? How will this be factoring into people's decisions moving forward? Will renters be looking for larger units or more bedrooms to accommodate an at-home office environment? And finally, how will the rental market be impacted by the affordability of home ownership due to historically low mortgage rates, and what will this look like moving forward? Until we have seen significant progress with the vaccination program, these are just some of the questions that we don't yet have a complete answer to, and we will continue to monitor as the recovery unfolds. Next slide. So this next portion of the presentation is moving into the discussion of sales. As you can see on this slide, the average sale price per suite has been experiencing a generally increasing trend over the last 10 years. There are some peaks and valleys. However, this is largely due to the small nature of the Winnipeg sale inventory, as there are some years that may be heavily impacted by just one or two significant sales. The slide is highlighting a flat rate for 2020. There have been a few transactions reported that occurred during the COVID period, and our discussions with a variety of local brokers, managers, and owners suggest minimal to no impact on sale prices arising from the pandemic for good quality properties. Next slide. When we analyze the trend of average sale prices, it is evident that age has a significant impact on a sale price per suite basis. Newer stock, as you can see here, is selling at around $200,000 a suite, while the average sale price for older inventory declined steadily from roughly $100,000 to around $60,000 a suite. Next slide. In regards to yields, our overall research shows that average cap rates have been hovering at around the 5% mark, with a marginally increasing trend shown over the last few years. The scale of this slide here is a little bit deceiving, but you can see we've got it going from 4.8 to just under 5.2. When we drill down a little bit further on these figures, we can see three distinct categories of data. So on this next slide, the red line is representing new and renovated product, as well as good quality, well-positioned assets that are generating rents that are considered to be at market levels. These category of sales have generally experienced average yields around the 5% mark. In the green, you can see that inferior, lower quality assets generally fall towards 6% and higher. And then the blue line is representing the inventory that we consider to be well located and acquired for reported repositioning. These properties have generally been falling anywhere between the 4 and 4.75 range, depending on the perceived upside potential. This is the only category where we have really seen what appears to be a generally increasing trend over the last 5 years. As appraisers, when we are determining market value, we not only analyze the yields and the sale prices, but we also analyze stabilized revenues and expenses. So on the revenue side, this includes the current rental rates and any significant upcoming adjustments that we need to consider, such as RTB confirmed increases. We also look at how the rents in place compare to market levels for similar type properties in the area. And we analyze current and historical vacancy levels, the level of discounts and inducements in place, and additional revenue such as parking, laundry, and storage. In terms of revenue trends, back up to that one. We are supposed to be, there we go, thank you. As both Peter and Rod spoke to, we're continuing to see a significant amount of new multi-res construction in Winnipeg. And so as a result, we're also seeing a definite increasing trend in rental rates. However, we are noting that rental incentives are becoming more common, both one-time inducements as well as monthly discounts, in order to both attract and retain quality tenants. We're going to be keeping an eye on this, as well as the impact on vacancy levels as the new inventory continues to be added to the market. And in regards to expenses, we analyze current, historical, and budgeted expenses that are experienced by the property, and we compare them to market norms in order to determine stabilized levels. This comparison is made under the individual categories of the expenses, such as insurance or property taxes and utilities. And we also analyze total expenses on a per door basis, as well as total expenses as a percentage of the effective gross revenue. When determining stabilized expenses, we exclude items that are considered to be capital in nature. Okay, now the next slide, please. Thank you, Peter. All right, so our research shows stabilized expenses typically vary between 35% and 50% of revenue, and from roughly $4,400 to $5,600 per suite. As these charts indicate, the older properties tend to experience higher ratios than the newer properties, as shown at the chart on the left. But the older properties also experience lower expenses on a per suite basis. Next slide. The three most significant expense categories that we analyze in terms of both dollar amount and the percentage of revenue fall under the repairs and maintenance, utilities, and property taxes. In terms of repairs and maintenance, seen here in red, these expenses can fluctuate widely from year to year and from property to property. However, once the capital items are removed, the range typically narrows very significantly. As one would expect, older properties often have higher stabilized repairs and maintenance expenses, ranging from roughly $1,100 to $1,500 per property or per unit, for properties that are 300 or 30 years or older. And of course, our newer builds typically range from roughly 800 to 1,000, so significantly lower than what the older properties are experiencing. And in terms of utilities, which is highlighted in purple on the chart, the levels of expenses that we find here will, of course, vary based on factors such as whether the rent is warm or cold, as well as perhaps the unit split that is in the property. Of the three major expense categories, we have found that there is the least variation in utility averages across the different ages and types of the apartment properties. And finally, this brings us to property taxes outlined in the light green. This is another category that we see significant variation in. This often arises from differences in assessed values on a per suite basis across similar property types. The next segment of our Altus Group presentation is going to be providing significant discussion and insight in regards to this topic. That completes my portion of the presentation. Thank you very much for your time. And Rod, I'll pass it back to you.
Sure, that was great, Sandra. Thank you much. A lot of very interesting insights into both the revenue and the expense side of the valuation. On the capitalization rates, I thought it was interesting. You talked about the key assumption survey, and most of those interviewed in the early parts of the pandemic predicted that cap rates would be relatively stable. And what you showed us is, in fact, that was the case. There was stability in the cap rates. The one category that was the high potential, I guess, not necessarily new property, but ones with potential of increase in NOI, that's the lowest of the cap rate categories that you showed, correct?
That's correct. So you've got a couple of comments that you've got there, Rod. So first of all, in regards to the impact of COVID. So of course, when there was the initial uncertainty that was happening, nobody really knew what the impact on yields was going to be. But as we moved along further through this pandemic, the multi-res market has proven to be very resilient, and we have returned to what we perceive as being pre-pandemic levels as far as the yields go. And in regards to the various categories of properties, we're definitely seeing the lower yields that are attributed to the properties that are required for repositioning. We do find, however, over the last several years, that the cap rates that are resulting from these transactions have not been quite as low as what they have been in the past.
Right. Yeah, there was an escalation from 2016 on. Very interesting. That's great. Thank you so much, Sandra. So
thank you.
I'd like to now pass it on to Kerry Reimer, Senior Director with our local property tax group, and he's going to talk about the largest piece of that expense pie that Sandra showed us, the property tax expense. Kerry?
Thank you very much, Rod. And thanks to everybody who's come into this webinar. We appreciate having you. Next slide, please. So I'm not going to make any assumptions as to the level of knowledge of the viewers of this presentation. So just going through some of the very basic aspects of property assessment. Our assessment cycle is typically 2 years in length. Now the province made a decision to amend the regulation to provide for a temporary increase to 3 years for the current cycle. So our current assessment cycle applies from 2020 to 2023. I suspect the pandemic certainly was a factor in that decision, and the assessment cycle reverts though back to a 2-year cycle in 2023. The valuation date for the present 2020 to 2022 assessment cycle is April 1st, 2018, and the property assessment should be based upon the present physical condition of the asset. So if your asset is improved or changes substantially within a given assessment cycle, then actually you'd be subject to reassessment within the cycle, and we'll talk a little bit more about that later. Next slide, please. So one of the interesting factors that we noticed, and this again is a function of an increase in both the assessment base and the taxes between two cycles. In 2019, we had an assessed value of just over $8 billion for multifamily properties in Winnipeg. That increased to just over $9.1 billion for 2020. Now, the valuation date, the reason for that increase in assessment was based upon two different valuation dates between the two cycles. The valuation date for 2019 was April 1st of 2016. The valuation date for the current 2020 assessment cycle is April 1st, 2018. So that increase from $8 billion and 50 million to 9.1 billion was a function of the updating of values in the assessor's opinion between those two valuation dates. the increase in the property taxes that were being generated from the multifamily assessment base, the increase was less pronounced, increasing 9.5%. That, of course, was a function of the tax rates dropping slightly in 2020 relative to 2019's tax rates. And that the city was able to do that, of course, because of the overall increases in the assessment base. Next slide, please. Another interesting statistics that we noticed was that its discussion this morning has actually highlighted that the number of properties, what we categorize as high-rise properties, is much smaller than the number of low-rise properties. But the high-rise properties actually increased at a much slower pace than the low-rise properties. The difference between 7.8% for the high-rise and 10.8% for the low-rise. That's not entirely surprising given the relative proportions of the properties within the entire market, but it was a statistic that we found interesting. Another very interesting statistic that we noted, and this one is a little less intuitive, the increase, as you see here in that second row, the apartments that were constructed between 1946 and 1959 saw by far the largest increase in the taxes per rental suite. And that, of course, would be a function of the increase in assessed value. So you can see there that was at 17.1% relative to a lot of the others that were in that between 6.5 and call it 9% range. The smallest increase was with the newest stock at 5.5%. So when we were conducting our reviews and appeals of the property assessments, certainly there were a couple of factors that very clearly came through. The capitalization rates applied by the assessment department for some of this older stock, particularly the smaller buildings, did result in substantial increases. And the other factor that we saw with the older stock generally is a lot of work by landlords on very significant and substantial rehabilitations or improvements that would have resulted in them applying for and receiving approval for renting increases above rent guidelines, which would also then have an impact on the assessed value due to the higher suite income for the properties. Next slide, please. So as far as cap rates, and this has been, my colleague Sandra had talked about the capitalization rates and some of the trends. And what we saw in assessment was for 2018, and recall that for the 2018-2019 cycle, the valuation date is April 1, 2016. The general capitalization rate range was between 5% and 6.75%. Contrast that with the current assessment cycle, which is based on a valuation date of April 1, 2018, where the range is actually wider. It's from 4% all the way up to 7.3%. Most of the capitalization rates that we've encountered are between 4.9 and 5.3, but the overall range was wider. And again, at the lower end of the range, that was primarily based on our experience, a function of some lower cap rates for some of the smallest multifamily buildings in the city. Next slide, please. In terms of the calculation and the deriving a capitalization rate, what is done in the assessment world can vary somewhat from the capitalization rate calculations that you would see for current value appraisal, but in general, the methodology is the same. We will take a look at the performance of the property leading up to the valuation date. We'll stabilize the financials or the income statements, both as to revenue and also expenses, to establish a stabilized NOI, net operating income, and then we will make adjustments to that implied capitalization rate to reflect specific characteristics of the property if it's warranted. Now, there's a very significant item, and has certainly been the subject of debate with respect to the inclusion of properties that are purchased with an intent to renovate or convert to condominium, and particularly with intent to renovate. A municipal board decision that was issued recently had confirmed the submission of Altus Group that these properties that were purchased with the intent to renovate, substantial renovations, should be excluded from the capitalization rate analysis, because of course the financial modeling that goes into these types of purchases is entirely different from a property where you're purchasing effectively the income stream that's in place and the asset that's in place. The modeling is very different, and the implied cap rate, once you work through that modeling, is much, much different than what it appears to be on the surface. So the municipal board agreed with our position in that the where you've got clearly the intent for substantial renovations, and that's the key, that those properties, the capitalization rate that would be implied with those properties are properly excluded from the analysis. In terms of the age bracketing for the capitalization rate analysis, the assessment department had typically bracketed or had a bracket leading up to 1974 and earlier, and then post 1975. From Altus Group's perspective, the largest group of apartments were built in the 1970s, and that we believe they were quite similar in construction. And so instead of the 1974 cutoff, what Altus has applied is a 1980 cutoff. The other thing that we notice is that, of course, the new stock that's been talked about, the new stock coming online, is going to put pressure and has been putting pressure on older properties concerning rents, vacancy, and the level of repairs and maintenance, because the expectations of people, of course, with the newer stock and the higher quality and the higher amenities, people's expectations in the market generally tend to go up, and some of this older stock is needing to invest more to keep up with that. Next slide, please. In terms of the capitalization rate adjustments, it's a debate. The capitalization rates to be applied in assessment certainly has been the subject of a fairly lengthy debate between the department and Altus Group, and the with respect to the number of 2012 assessment appeals at the municipal board, a test case was held. I think it was about a year and a half ago now, and the board in that case agreed that there were capitalization adjustments were required, and several of the capitalization rates were increased anywhere between 75 and 100 basis points. Since that time, Altus and the assessment department certainly have been in active discussions since in subsequent assessment cycles, and we have in many instances been able to agree, and that's been resulting in adjustments to the capitalization rates of between 25 and 50 basis points for a number of asset classes. Those discussions continue to this day based upon the year of assessment that's in appeal and the factors within each cycle. Next slide, please. So one of the other hot button items, I mentioned capitalization rates, and the other very significant item that's typically under debate in the assessment reviews, and particularly the appeals and hearings, relates to the distinction between an item that should be properly classified as repair and maintenance versus capital. My colleague Sandra had alluded to this, that of course capital is something that is not included in the analysis and the calculation of an NOI, and Altus Group property tax, of course, takes the same view that if it is truly an item on account of capital, that should not be included in the operating statement when we're calculating the net operating income for the property. But the distinction between, or the line between, an R&M item versus capital isn't always clear. So some of the factors that we look at is the quantum of the expenditure. If you're sort of bumping along, by way of example, if you're bumping along for a number of years with a painting expense of, say, $10,000, and all of a sudden in a given year the painting expense goes up to 40 or 50,000 because effectively the entire exterior of the building or a significant component of the interior is completed all in one time, that would be an indication that it would be more on account of capital. The recurrence of the expenditure is another item that we look at along with the expected life of the expenditure. And this is a little tricky, but the question that arises is, does the expense that's under examination genuinely improve the asset beyond its condition prior to the work? If it truly does so, it would be considered on account of capital. And an obvious example is if you've got a roof that needs significant work and you continue for a number of years to patch and repair it, that's typically on account of repairs and maintenance. But then if you decide to replace the roof in one shot or a significant segment of that roof, that would typically be on account of capital, and that you've actually improved the economic life of the asset. Next slide, please. Repairs and maintenance, along with property tax, accounts, of course, for a large proportion of the expenses, and you do want to ensure that the R&M expense is accurately represented. within a given age category, what we're finding, and it stands to reason, that a higher repair and maintenance expense per suite tends to be associated with higher rents. Because within certain regulatory guidelines, landlords with that expend significant amounts of repairs and maintenance can apply for above guideline rent increases in our rent controlled environment. But even more importantly, the higher repairs and maintenance will tend to attract a higher, an ability for a greater revenue stream as people are moving into buildings with that higher quality standard. So within each repair and maintenance expense category, the expense amount is analyzed and stabilized based upon data over a number of years leading up to the valuation date to give a true indication of what an investor, as of the valuation date, would project into the future, which is what's used to calculate the net operating income. Next slide, please. So supplementary assessments, and I alluded to this briefly earlier. The actions of the assessing authority are governed by legislation, and he can only act within the framework of that legislation. And what the legislation provides are some very, very specific reasons that a supplementary assessment within a given assessment cycle can be issued. It can range, as you can see on the screen there, it can range from anything from new construction up to an error or omission and everything in between. And there could be a merger of roles, there might be a subdivision, a substantial renovation, or in some cases, not so much with respect to multifamily, but if you've got a situation where there's a change in classification or liability to taxation, that's another reason to do so. Next slide, please. So the most significant pitfall that we found over and over throughout the years with respect to supplementary assessments relates to a legislated, extremely short 20-day window to file an appeal of the supplementary value if you're not content with the value that the assessors put on the asset. So the unfortunately, and this is no fault of the assessment department, this is directly from the legislation. The legislation states that an appeal must be filed within that 20-day window, and if the appeal is not filed within that 20 days, your right of appeal is lost. So it is exceptionally important to review all documents that are coming from the property assessment and taxation department immediately to make sure that that window is not closed on the appeal period. So one of the items that has arisen, not often, but certainly the bit of a gray area relates to the error or omission segment of the legislation and what exactly that means. Certainly an error omission, no doubt, if there is truly an error on the record, that is something that is capable of and should be corrected. But what it doesn't include, we're convinced, is a change of opinion concerning the assessed value. A change of opinion within an assessment cycle for what amounts to the same physical asset as you had at the start of the cycle, that we don't believe is authorized or intended by that phrase error or omission in the legislation. Now, it's also important to note that a supplementary assessment can be retroactive, and the simplest way to think about it is that the supplementary assessment can be issued for the current year plus 1 year prior. So if it can't go beyond that, if the department for whatever reason hasn't caught up with a substantial renovation on your property, and that renovation was completed a few years ago, the legislative authority ends at January 1st of the year prior to the year in which the change occurred. So that would be the extent to which you would potentially be liable for the increased taxes. Next slide, please. The request for information. So the assessor, both the provincial assessor and the city assessor, has legal authority to request a number of different types of information from property owners. In the case of the multifamily buildings, the most significant annual request relates to the income and expenses of the property for the calendar year. And those, as I'm going to talk about shortly, there's significant penalties for non-compliance with those requests. So it is exceptionally important that you comply fully with these requests as received. Other types of questionnaires that can be sent out are sales questionnaires, requests for inspections, cost letters, and other miscellaneous kinds of requests. The most common of these are the income and expense questionnaires and the sales questionnaires. Next slide, please. So I talked about the penalties for the income and expense, non-compliance with the income and expense questionnaires. this is the penalty provisions in the Act, and there are a few of them that relate to the consequences of noncompliance. The penalty for noncompliance with the income and expense questionnaire, which is under our section 16(1)(c) of the Act, is by far the most severe, and it amounts to a forfeiture of the tax savings for the first year affected by the appeal. What the Act actually, the wording of the Act says is that the reduction in the assessment that's ordered will only take effect in the year following the year to which the application relates. So by way of example, if you had appealed your 2020 assessment but were found to be non-compliant, then, and the board ordered a reduction in the assessment, that reduction would not take effect in 2020, but only in 2021. This penalty has cost many taxpayers many thousands of dollars, and reinforces the need to fully comply within this statutory timeline with these requests for income and expense information. Other penalties that are not as severe, but still certainly there and meant to encourage compliance, relates to the shifting of the burden of proof to the assessor, or from the assessor to the owner at the hearing. Next slide, please. I guess actually that is, I thought I had one more slide, but I guess that's the end of my presentation. Thank you very much for listening.
That was excellent, Kerry. Very thorough discussion on assessment methodology and some comments on best practices for owners and managers. Before I do have a question, but before I do that, I'd just like to mention to the audience that if you have any questions, please feel free to use the Q&A button, and we'll monitor those. If we do run out of time, please feel free to contact any of us directly. Our contact emails are included in the slide deck that will be distributed. So Kerry, just very quickly then, you mentioned something at the beginning that typically in the cycle of assessments, 2022 in Manitoba would be a reassessment, but that has been postponed by a regulatory revision until 2023. So yes, what that means then, if I understand, is that any effects, economic effects since the reference date, April 18, which include but not limited to COVID, any positive or negative effects on property values, will not be reflected in, again, the 2022 assessment.
Yeah, that's exactly right. So, and sort of my colleagues alluded to this earlier, where perhaps this multifamily sector hasn't been affected in the same way that the hospitality and entertainment and retail sectors have been, but certainly the valuation date for this assessment cycle, as I've noted, is April 1st, 2018. What that means is that taxpayers are not able to, and this has been confirmed both by the courts and the board, municipal board decisions, evidence of economic conditions after the valuation date cannot be submitted to the panels or to the board members at these hearings. So you're restricted to evidence economic conditions and how the property was performing up to April 1st of 2018 and not past it. Having said that, certainly there's an opportunity, and again, the courts have confirmed this, that within a given assessment cycle, it's the same valuation date, and if there's no physical changes or no reason for a supplementary assessment, any value that is set for 2020 either initially or on appeal carries forward through the rest of the cycle. But the courts have confirmed that taxpayers do have an annual rate of appeal for their property. Now, having said that, if an appeal is filed in either year 2 or in this case with the current cycle, year 3 of the assessment cycle, typically the boards would tend to follow a previous decision of that board unless new evidence was presented. So certainly we're in a position where we encourage people to take a second look at it. We are in a position where we will be asked to take a second look and are happy to do that. And should our review result in a recommendation to appeal, we are secure in the knowledge that an appeal is certainly available for the City of Winnipeg taxpayers. The next deadline coming up is going to be in mid to late June, and it will be for the 2022 assessment. So that's certainly something that taxpayers should keep in mind.
Okay, excellent. Thanks so much, Kerry. So we've covered a lot of ground this morning. And I guess the general theme, I started off the presentation by talking about the excitement in the market, and it is. There's a vast amount of great quality new supply coming on the market. That is always good for the city. It will help ease where we are seeing concern in affordable housing. That's a whole other topic that we won't get into today. But where we are at now is a bit of a precipice, and what we're looking into in the near future is uncertainty. Peter talked about the fact that this won't necessarily be a bounce back from the pandemic. We're going to see lingering effects to the economy. Sandra mentioned that we're seeing evidence of some of that strain in the rental rate she's examining with incentives and discounts. There's discussion about the record low interest rates, but what that also means is that, as Sandra and Peter had mentioned, home ownership is becoming, I think, surprisingly, that market is active, more surprising than any of us would have thought a year ago. And of course, that is a competing factor against the rental market. So the takeaway, I think, of this entire session is that we're heading into uncertain times. And I think more than ever, those in the industry should follow, as I know most of the audience who I've dealt with do, full diligence and prudent analysis in all of their actions with their assets. So thank you very much again to Tom and BOMA Manitoba for hosting this morning's event. Thank you very much to all of you for attending. We'll take some questions now, and then we'll sign off. And again, if you don't have a chance to ask a question now, our contacts will be in the slide deck that will be distributed, and please feel free to reach out. So there is one question that was asked. Question for Rod Slaughter: the number of new suites and suites pending construction. So this is what we talked about just after Peter's presentation. This includes all recently rezoned mixed use and multifamily properties. If so, what is the cutoff date for Altus's data set? Great question. So we talked about the existing inventory, and the cutoff for that, as I mentioned, is when it was assessed. So that means, as an example, P3's new development at 221 Stradbrook, that is now occupied. I don't believe it's assessed yet, at least the last I checked. So it's not part of that inventory. It's part of our, what we call the pending inventory. But the cutoff on the other end is from when a permit is taken out with the city. And so what we do is we obtain the permits on a monthly basis, and we examine each and every one of them. And we try and determine what that will mean to the city's apartment inventory. What it does not include, though, as the question asks, is recently rezoned mixed use. We're watching that. We're watching city council minutes to see what's happening in all areas of the city, but we consider that, in our definition, longer term pending, because we imagine it's not going to be part of the market within the next year or two. So to answer your question, no, it does not include recently rezoned, and the cutoff date is when an actual permit is taken out with the city of Winnipeg. So thanks for that question. If there are any others. Well, I think we're coming close to, amazingly, that we're coming close to our cutoff time. Oh, a couple more questions here. Oh, just a chat. Thank you very much. So again, please feel free to reach out to any of us. We're more than happy to chat about this. Thank you again for attending. Have a great rest of your year and stay safe. Thank you very much.